In this video, we are going to talk about candlesticks, swing highs, swing lows, liquidity sweeps, and liquidity runs. Thank you guys for tuning in. Make sure y'all like this video and subscribe to the channel. So there's two types of candles. We have a green candle and we have a red candle. Both candles represent four different things in price. You have the highest price, the lowest price, the opening body of the candle, and the closing of the candle, right? So when you're looking at the green candle, the lowest point of the wick of the candle is always going to be the lowest price, meaning that in the live market, that's the lowest that candle went. And the highest price is always going to be represented by the wick of the candle, which is always essentially the highest point in which that candle went in the market, right? The highest price point. And the closing price is going to be represented by the body of the candle. And the opening price is going to be represented by the body of the candle as well. So the opening price is going to be represented by the lower part of the body, and the closing price is going to be represented by the higher part of the body of that candle. The same thing with a bearish candle, right? It represents the same four things: the highest price, the lowest price, the opening, and the close of the candle. And the same thing is represented for the red candle as well. You have four different things: highest point, the lowest point, the point in which the candle opened, and the point in which the candle closed, okay? And the opening price for bearish candles is always going to be at the top of the body instead of the bottom of the body like the green candle. And the closing price is going to always be the lower part of the body of the candle compared to the green candle, which is at the higher point of the body, right? And obviously for bearish candles, we have the top of the wick is where the highest point in which the market went up for that candle, and the lowest part of the wick is the lowest price point in which the market went for that candle. Now let's look at swing highs. So when you want to identify a swing high in the market, you just have to realize that it's a 3-candle pattern, okay? And when you're looking at this 3-candle pattern, the candle in the middle always matters the most, okay? When you're looking at the wick of that candle in the middle, the wick of that candle should be higher than both the wick and the body of the candle to the left and the right of it. And that's essentially all you need to focus on. It has nothing to do with the body of the candles. You just have to really focus on the wicks, okay? Remember, the wick and the middle candle should be higher than both the wicks and the bodies of the candles to the left and the right of it. The last important thing to note is that it's a 3-candle pattern. So you do not have a swing high or a swing low if it is only 2 candles. For example, if you're looking at this pattern on the daily time frame or the hourly time frame, you have to make sure that you have a 3-candle pattern. And the same thing applies for a swing low. A swing low is the same thing. It's a 3-candle pattern. The middle candle is the most important candle to look at, right? Because the wick of that candle should be lower than the wicks and the body of the candles, of the candle left and right of that middle candle. And that is essentially how you identify a swing low in the market. This is very important when it comes to reading price action, when it comes to determining market structure. This is something that you really have to know as a trader, because you will use swing highs and swing lows every day in the markets. So make sure you guys know what a swing high and a swing low is. Now that you can identify a swing high and swing low, we are going to talk about the next most important candle you need to be able to identify, which is the displacement candle. Now, the displacement candle is essentially just a fast move in the market, okay? Now, when the market makes a big fast move, typically it leaves a big candle, right? And that's essentially all a displacement candle is. It is a candle that's much more noticeable than all of the other candles. So as you can see in this example, right, that displacement candle is much bigger than all of the other candles on the chart, right? When you see these candles, you should instantly draw your attention to these type of candles, because typically this means that the market is now ready to make a big move. It's ready to make a big push in either the upside or the downside direction. Also, when a displacement candle happens, right, when it forms, it typically leaves a gap in the market which is known as a fair value gap. And ICT teaches that there's two things that moves the markets. There's gaps in the market and there's liquidity, right? Those are the top two things that moves the market. And when you're trading, you want to be able to identify these things immediately. Now let's identify the next most important thing you need to know as a beginner day trader. And I'm telling you right now, if you can start identifying these things in the markets, you are well on your way to becoming a master day trader. This is a liquidity sweep. Now, when you're identifying a liquidity sweep, the most important things to note is the wicks and the bodies of the candles. So typically when you're looking at a swing high or swing low, in this example, we are looking at a swing high, liquidity is going to be resting right above that swing high. So when the market goes above that swing high and it comes right back below, that is what we call a liquidity sweep. Okay, and this is essentially what you want to see before you enter a trade. And also typically this is what happens right before a big displacement candle happens, right? So my challenge to you guys is to go in your trading view, go into the charts and find these liquidity sweeps. And then we're also going to talk about what is the difference between a liquidity sweep and a liquidity run. So a liquidity sweep essentially means that the market may not be done with that high, right? It typically goes up and create a new swing high. And typically what you can expect is for the market to eventually go back up into that new swing high and sweep it again, or what I like to call run liquidity, right? So what you would typically see is a liquidity sweep first and then followed by a liquidity run. So what a liquidity run is essentially when the market is not, it's essentially a continuation pattern. For example, if the market is downtrending, right, and you see a liquidity sweep, what you're going to see is that market is swept out a swing low and then it pulled back up. Versus a liquidity run, if we're in a downtrending market, like in this example, you're going to see that market continue to the downside, running out liquidity completely, meaning that it is now officially done with that swing low that is swept out in the market.